Welcome and thank you for joining me for Tax Break. This is a podcast about South African tax for South African tax professionals and practitioners. My name is Pieter van der Swan, and in each episode I share my thoughts with you on a topic or a recent development in the field of South African tax. And I try to do it in no more than the time that you would have available if you want to enjoy a quick cup of coffee while taking a break from work. Today we're talking about assessed losses and two relatively recent developments relating to assessed losses. So when we think about an assessed loss, you should be thinking about Section 20 of the Income Tax Act. Now, what Section 20 says is that if we firstly look at what is an assessed loss, that's really that the result if a taxpayer has got more deductible expenses or more deductions than it's got income for the year. The outcome is that the taxpayer is in a net loss position, and that net loss is referred to as an assessed loss. The legislation then also talks about this balance that's carried forward as the balance of the assessed loss for the year that carries forward into the next year of assessment. And the taxpayer is then entitled to utilize this balance of assessed loss carried forward against its taxable income in future years of assessment. Now, the two developments that we are going to look at, the first one happened about a year and a half, 2 years ago, and that was the introduction of limitations on the extent to which you can utilize the balance of the assessed loss. So if we're looking at the company, you may know that for years of assessment ending on or after 31 March 2023, the corporate income tax rate was reduced from 28% to 27%. And with that reduction in the corporate income tax rate, there was also an amendment to Section 20 to limit the extent to which a company can utilize its balance of assessed losses. So the reduction in the corporate income tax rate was really, the idea was that there would be two other amendments that would balance the tax base. One being this amendment to the extent to which you can utilize assessed losses. The other was an amendment to Section 23M. Now, what Section 20 says after the amendment is that if you determine the taxable income from a company's trade, you may set off against the income so derived the balance of the assessed loss, so in other words, that balance carried forward from previous years, to the extent that the set off does not exceed the higher of two amounts. The first one is R1 million. So that's really a de minimis threshold that if the balance you're going to want to utilize is R1 million, that full million can be utilized. Or then 80% of the taxable income for that year of assessment before taking into account the balance of the assessed loss carried forward from previous years. So let me perhaps explain it with some numbers. Let's assume we've got a company with a balance of assessed loss of 20 million rand that's carried forward from previous tax years. And for the current tax year, that company has got taxable income of 10 million rand. So the principle is that the company can utilize the balance of assessed loss of 20 million rand against the taxable income of 10 million rand, but they're now subject to the limitations. So the limitation is the higher of R1 million, or then in the case of the company with a 10 million rand taxable income, 80% of that 10 million rand, so 8 million. In this case, 8 million is the higher of the two. So the taxpayer in the year in which it earned the 10 million taxable income can utilize 8 million of the balance of the assessed loss. That balance of the assessed loss, the 20 million is then reduced by the 8, and you've got 12 that you can carry forward and utilize subject to these same restrictions. So that's the first development. The second development is much more recent, and that's SARS issued Binding General Ruling number 73. So unlike binding private rulings and binding class rulings, these binding general rulings apply to all taxpayers. The question that Binding General Ruling 73 deals with is, can you take your taxable capital gains into account when determining the taxable income to which you apply the 80% threshold? Now, to maybe just put it into perspective again with some numbers, so let's go back to my 10 million taxable income example. If the taxpayer in that case had a 1.25 million capital gain, that would have been included into the taxpayer's taxable income at 80%. So the taxable capital gain included in taxable income would have then been R1 million. So the question is really, should you apply the 80% to the 10 million, which includes the 1 million taxable capital gain, or should you take the taxable capital gain out and apply the 80% limitation to the 9 million rand that remains? Where this issue came from, there were some assessments and disputes where I understand that SARS applied it to taxpayers to say, but you should take the capital gains, the taxable capital gains out. And the interpretation issue seems to have been that if you look at the introductory wording of section 20, it talks about your taxable income from a trade. Now, these capital gains don't really relate to trade, or they don't always relate to trade. If, however, you look a bit lower down in the wording where you find the 80% restriction, that doesn't talk about taxable income from your trade. It just talks about taxable income. So SARS's view that they confirm now in Binding General Ruling 73 is that your taxable income for purposes of applying the 80% is your taxable income including your taxable capital gains. I believe that this view is also, if you were to look at it a bit more conceptually, if you look at the SARS Comprehensive Guide to Capital Gains Tax, specifically paragraph 5.9, there SARS clearly states that if you've got a taxable capital gain that's included in your taxable income, you can set off assessed losses against that taxable capital gain. So I think it would only make sense, if you look at it from that perspective, to include all the amounts that you can offset the assessed loss against when applying the 80%. So Binding General Ruling 73 is really consistent with this interpretation, and it confirms that these capital gains, the taxable capital gains, can be included in the taxable income to which you apply the 80%. So in summary, to close, I think the two things you can take from today's episode. Firstly, you need to be aware of the restriction in utilizing a company's assessed losses. Secondly, you should take that there's good news in the sense that taxable capital gains form part of the taxable income to which you apply the 80% restriction. That's all for today's episode. If you enjoyed the episode, please subscribe on your favorite podcast platform and tell all your friends and colleagues about it. You're also more than welcome to send me any feedback, or if you've got topics that you would like me to discuss on future episodes, please drop me an email. My email address is in the show notes, and I'll see if I can build a future episode around your suggestion. Just as always, a reminder that nothing in this episode was meant to be tax advice or even a replacement for fact-specific tax advice. Until next time, goodbye.